Hi guys, welcome to the most important video lesson of our trading course. But before we start, I'm going to ask you a question. What do you think is the number one reason that a trader goes broke? I bet many of you would say bad luck, but it's not. We think that the number one reason why a trader loses all his money is because of a poor risk management strategy. Ask any professional trader for one tip on how to start trading, and I bet a lot of them will advise you to practice sound risk management. How much you're willing to risk in one trade should always be inseparably connected to the size of your bankroll, to the expected gain, and to your win rate. In this video, I'll explain important points like how to determine and protect your bankroll. Afterwards, I'll be revealing some specific strategies on how to properly manage your bankroll. Next, I'll also be talking about the importance of using stop losses. After that, I'll explain the risk to reward concept and how it relates to the win rate. I'll also tell a story of how things will likely play out if you'll ignore the risk management rules. And at the end, I'll talk about emotions as well, although there is a whole video dedicated just to emotions in our advanced course. Risk management may sound complicated, but it's the most important lesson of the entire trading course, basic or advanced. Even if you become a spectacular trader who knows everything about entries and targets, trend lines, support and resistance, and so on and so forth, you'll eventually lose all your money if you ignore the risk management rules. Even if your win rate is 70%, you can still lose 5 or even 10 consecutive trades. Without knowing the appropriate position size, you can lose it all very fast. Alright, so how would you best determine the size of your bankroll? Well, the golden rule is that you use only the money you can afford to lose. This means that the money in your bankroll is only needed to fund the trading. So if you think you have a $5,000 bankroll, but you know you will need to use $1,000 to pay next month's rent, then you really have a $4,000 bankroll. This is really important. The money that is intended for trading should be strictly reserved only for trading. If you don't follow this rule, you will trade less than optimal. You will be exposed to severe pressures like fear of getting thrown out of your apartment in case of losing money while trading. Another thing to consider is the fact that the bankroll size could be changing a lot. If you lose money in one trade or a few consecutive trades, your bankroll is effectively smaller, and you should consider that when you're making future trade decisions. And if you win money, you have two options. Either deduct the surplus so the size of your bankroll stays the same, or add money to the bankroll. If you decided for that option, your bankroll just got bigger, and you should do future calculations based on your new larger bankroll. Don't do the math after every trade. It would be too time consuming, especially if it's well spread around, but the 15% change in size should definitely be noted. Real bankroll size could be bigger or smaller than the amount you have on crypto exchanges. I already explained the case how some people trade with money that is intended for necessary monthly expenses, like paying bills. This money must be deducted from the bankroll. On the other hand, your bankroll could also be bigger than the amount of money you have on crypto exchanges. It is a wise decision to keep a part of your bankroll somewhere else than on crypto exchanges. Somewhere safer, like in a bank account if it involves fiat money, or on hardware wallets where you hold cryptocurrencies. We recommend you keep just the needed trading amount on exchanges. Here it's important that the money is not just on one exchange. Spread your money across different exchanges with exceptional security features. It will always be vulnerable to some extent, but that's the risk every trader has to accept. The crypto exchange scams and hacks are real, so make sure you protect your bankroll. Now, let's talk about how you can properly manage your bankroll. Here are two rules you should never break. Never risk more than 5% of your bankroll in a single trade. Never open a position size that represents more than 50% of your bankroll. 5% risk represents the amount that you lose if your stop loss gets hit. This is not the position size. A stop loss is hit when a stop loss order is triggered in order to close a position at a certain price in case the price goes in the opposite direction as anticipated. I'll talk more about orders in the next video, but just for the taste, this type of order is most useful when we want to manage risk once we're already in a trade. It is designed to limit the loss in a trade that doesn't go as expected. And the 50% from the second rule is the size of the trade position compared to the whole bankroll. Sometimes you'd be able to risk less than 5% of your money, but the position would still be larger than 50% of your bankroll. In that case, don't use the full potential of a trade. It's better to lower your percentage of risk and come under 50% of your entire bankroll. I would strongly recommend that you start trading with a maximum 1% risk instead of 5%. Trading with a 5% risk requires years of trading experience, lots of practice, and strong understanding of the cryptocurrency market. As you'll get better with time and practice, you can adjust the risk gradually and eventually come to that 5%. Although many successful traders I know, including myself, prefer to risk around 2 to maximum 3% of the bankroll in one trade. In case I lose above average amount of trades, I usually lower the risk until I get back on the right track. Lots of noobs in that situation start revenge trading and increase the position size to get the lost money back. This is another no-no. If you're not synced with the market, always reduce the position size and risk. Never do the opposite. Now, let's look at an example. First thing you have to determine is how big is your bankroll. For the purpose of this example, let's say you're trading with $10,000 and you decide that maximum amount you're willing to risk in a trade is 1%. So if the bankroll is $10,000 and you're willing to risk 1%, that means you're actually willing to risk maximum $100 in case your stop loss gets hit. Don't mix that number with position size. I'll show you later on how to calculate position size relative to the amount of risk you're willing to accept. This just means you'll lose $100 if you get stopped out, and not that you'll open a position of a size of $100. And because you should never use more than 50% of your bankroll in one trade, your maximum allowed position size would be $5,000. Okay, now let's look at how you can calculate the position size. After you determine the size of your bankroll, maximum risk you're willing to take, and how far from the entry you'll place your stop loss, you can use this simple formula. Position size equals total bankroll times risk percentage divided by stop loss in percentage. So, we know your bankroll is $10,000. Maximum risk you're willing to take is 1%, and the trade you're planning to open has a stop loss 4% away from your entry. So the calculation goes 10,000 times 0.01 divided by 0.04 equals $2,500. So maximum position size in this case would be $2,500. Now let's change the last variable. In your new trade setup, stop loss is only 1.6% away from your entry. So by this new calculation, your position size could be $6,250. But because of the second rule where we said that you should never expose more than half of your bankroll in one trade, your actual maximum position size could only be $5,000. Everything I just explained is simple mathematics, and I suggest you practice it. This will be one of the reasons why you'll still be around making money while others will get completely wrecked and you will never hear from them. No matter how good the potential trade looks like, don't ever cross these lines. Another important rule of risk management is always use a stop loss. Before you enter a trade, you should know where you'll exit. Not just where you'll take profits, but also where you'll close the position in case the price goes in the opposite direction as anticipated. There should always be a point where the setup is not valid anymore. Here, I also want to touch the subject of moving the stop loss. General rule is never move the stop loss in the direction that will increase your risk. It is acceptable to move the stop loss to break even or in profit in case price action is favorable. Just be careful that you don't do it too soon. Many times when I was too eager and I moved stop loss in profit too fast, I got stopped out and later the price hit the target. With practice and time, you'll get the touch when it's okay to move it and when it's better to just leave it. But like I said before, it's never okay to move it in the direction that increases the risk. Think about where your trade setup becomes invalid before taking the trade and place the stop loss based on the price action. Usually this level is quite obvious. If it's not, or if the risk is too great compared to potential reward, just don't take the trade. The things that I just explained will make more sense for our advanced course students who are already learning about technical analysis. Okay, let's continue with the next subject, risk to reward ratio, or simply R. I hope this part won't be too confusing. I'll be using some vocabulary and concepts that are a part of the advanced course, so please bear with me. It's for your own good that you learn about it sooner rather than later in case you decide to become a trader. Risk to reward ratio tells you how big is your risk compared to the potential reward in a trade. The formula goes risk to reward ratio equals reward divided by risk. There's a simple tool in TradingView that will calculate risk to reward for you. For a long position, you can choose this one. And for short, you can choose this one. You can actually determine account size and other things here, but how I use it is very simple. Let's say I want to open a long if price comes here. This is where I'll place my stop loss, and this is where my target is. I'll place the tool and drag the lines to my target and stop loss. As you can see, the target is 15% higher and the stop loss is just over 5% away from the entry. And the risk to reward, or R, is this number here. In this case is 3.25. Let's also quickly calculate the position size as well. In my strategy, I use 2% maximum risk and the bankroll is $10,000. The formula goes bankroll times risk divided stop loss equals position size. 10,000 times 0.02 divided by 0.04 equals $5,000. Okay, let's go back to R. As a general rule for new traders, I would say to only take trades that have risk to reward ratio at least 2. Meaning, if you risk 1 unit, you should only take the trade if expected reward is at least 2 units. Or for instance, if your stop loss is $50 below entry, only open a long if your target is at least $100 higher. However, there is actually no magic winning number in risk to reward ratio. It all depends on your trade win rate. Traders with high win rate can take lower risk to reward trades and be profitable. On the other hand, traders with low win rate who only take high risk to reward trades can be profitable as well. For instance, if you win 51% of trades and lose 49% of trades, you would be a winning trader with risk-to-reward rate of only 1. If your risk-to-reward ratio is 2, you only need to be right 1 out of 3 times to be break-even. If you are right more than 33% of the time, you'll be a profitable trader. Once you start trading, I highly recommend you start writing your personal trade journal. The thing is, you can calculate your win rate only from analyzing your past trade performance. Furthermore, you'll be able to find flaws in your strategy and improve. And now, I'll tell you what will happen if you'll ignore the risk management rules. It will probably go like this. You'll open trades of hyped coins near reversal with promises of delivering you the next 10 times. Of course, you'll want to make the maximum profit out of this trade, and you'll go all in full digit mode. You'll eyeball your stop loss at a desired level, and you're ready to moon. Let's say next morning at the first sign of problems, you'll move your stop loss lower because the price is dangerously closing onto it. Without knowing, you'll be already risking 15% of your bankroll. And then the unimaginable happens. You're out. Angry and frustrated, you re-enter the trade. Of course, all in, because you want to cover the losses from the previous trade and make some extra profit on the side. This time, you're 100% sure that the price will go up, not exactly sure where, so you decide to trade without stop loss. You believe in karma, you're good to your neighbors, mow your grandmother's lawn, and pray a few Holy Marys. Before going to bed, you check one last time how your trade is doing. A few percents up, fuck yeah, I knew it. Next morning, you didn't sleep well. You check your trade first thing in the morning and bam, wrecked. 25% down since last night. Fear and panic rule your day. The dump continues and you panic sell. Afterwards, you don't want to check your balance, but still you look at it. You're down 50% of your entire bankroll in just 2 trades. Now you have to make 100% just to go back to break even. Guys, this kind of story is unfortunately unfolding on a daily basis in front of market participants. I told you the fast version of the story, but easily the same ordeal can last a few months or a year. But a trader who follows the bankroll management rules and risks no more than 2% per trade still has over 95% of his bankroll left. Do it right or you'll get wrecked. Beside the set risk percentage, you should also consider the psychological barriers. At any circumstances, don't ever take a trade that you can't mentally handle. Be 100% sure you'll stick to your plan, and maybe change it if you'll find plausible reasons. For example, in my early trading days, I sometimes felt that a trade is taking too long and it was dangerously close to my stop loss limit all the time. I backed off and broke my sacred rules. I sometimes closed the trade before the setup was invalidated. The next moment it bounced back and went up gradually to my target. And because I couldn't hold my nerves together, I lost some money instead of making a decent profit. For me, it was a lesson learned the hard way. Having weak hands is a common thing in trading. To avoid this, you have to be mentally prepared in advance about how much money you're willing to lose. If you decide on a 2% risk, but $200 actually means too much for you, you should accordingly lower the amount. Don't go the other way though. If $200 seems nothing to you, still stick with it for a while. Make sure your risk grows with knowledge and experience. Thanks for watching and see you in the next video.